Hello, this is Jürgen Herzog at Better Homes and Gardens Real Estate Best Life. I'm a real estate broker here in California on the Central Coast for over 27 years. And today I want to talk to you about how to avoid paying taxes. Sounds good. This is more real estate related, so I can't help you much with your regular taxes. But if you're owning an investment property, and that can be a piece of land, a duplex that you're renting out, there is a way to avoid paying taxes on that property when you sell it. So first of all, we all know nothing is for sure but death and taxes. And whenever you sell an asset and you make some money, be sure Uncle Sam wants a share out of it. So if you sell a coin collection, an old antique car, your stocks, or real estate, yes, the state, the government wants a share of it. And there are some exceptions to the rules, luckily. If you sell your primary residence, you're somewhat exempt from at least a certain amount of paying taxes. But if you sell your duplex I mentioned earlier, that you're renting out, or piece of cattle land or land to develop later on into a subdivision, and you gain value over the years and you sell it, yeah, that gain is going to be taxed. That's called capital gains, and there's a capital gains tax that you have to pay. And please, before you take any action, always run it by your tax attorney to make sure that the laws have not changed, and the devil is in the detail, so make sure that you get proper advice. So how much tax are you looking at? Let's say you bought some real estate and now you're selling it with a profit, and you held that real estate longer than 1 year. It's long-term gain, and that is taxed on different levels, 10, 15, or 20%, depending on the tax bracket you're in. But most people will pay the 15% capital gains on the profit they're making with that property. And then if you're living in the state of California, you have to pay additional tax to the state. And in California, again, that's depending on the tax bracket you're in, but I would estimate 9.3 or 10.3%. That's where most people fall under in the income bracket. So you're looking at 25% total. And if you make 400,000 gains, that's $100,000 going to your government. The good news is you can avoid paying capital gains tax on your real estate via a 1031 tax exchange. It's actually more a deferring of that tax burden, but that means ultimately you don't have to pay when you are making the money. But there are some stipulations you have to follow and some guidelines. First of all, you cannot cash out. That means you're not getting that money. You actually have to reinvest it in likewise property. In real estate, likewise property is other real estate. It's the basis, double check in each case, but if you have a piece of land and you're selling it and you want to buy, let's say, some rental units, a condominium or single family dwelling, that should still qualify as likewise. That means that's the first hurdle you took. You're taking your profits and reinvesting it in a likewise property. You also have to watch out about timelines. So let's say you close on your piece of land that you're selling and you're looking at this great little duplex you're buying. You only have 45 days to identify that property you're purchasing. And then you only have 180 days to close on that transaction. And to avoid all taxes, the property you're going to buy has to be of an equal or higher value. And last but not least, you cannot take that money out. Let's say you sell your piece of land, you get your $500,000 in this example. The moment you get it into your hands, the 1031 tax exchange is off the table. You will have to pay taxes even if later on you buy the other replacement property. So do not touch the money. Use a 1031 tax facilitator to hold the money, to make sure that you're within the timelines and everything is done properly. If you mess up on the timelines, or realizing that gains at one point, being transferred to your account, you will lose that tax benefit I'm talking about. But you know how life is. Sometimes you haven't even thought about selling your condo that you rented out for many years, but then you find this really cool investment property somewhere that you need to buy and you want to buy, and then you're thinking, well, I could sell my condo later on because I don't need it anymore, I have this better investment. But how do I avoid paying capital gains on that sale? Well, that would be called a reverse 1031 tax exchange. You can buy a property first and then sell your property after that and avoid paying taxes on that transaction. But again, there's requirements, stipulations you have to stick to. You are not allowed to buy the property that you fell in love with, that you think would be a great investment for you, and hold the property that you want to sell later on under your name at the same time. That would kill the reverse 1031 tax exchange. But you could hire a company that acts as an exchange accommodation title holder. And there's companies that offer that service. So you buy the new property, you're not holding officially title, and then again you have 45 days to identify the property you want to sell. In our example, it was the condo you want to sell. And then you have 180 days again to close that transaction. And that way you can transfer the tax base from the old property into the new one and defer the capital gains. 1031 tax exchanges are a fantastic tool if you want to stay in the business, but you want to liquidate one property and roll over the capital gains you created hanging on to that property for years into a new property. If you have more questions, feel free to reach out to me or my business partner April Whitehead. We're glad to help you. We were part of many 1031 tax exchange transactions with our clients. We're happy to help you. Always run it by your tax attorney and tax advisor before you do anything. And I hope you enjoyed this video. Till next time.